is to, once you see a real setup, a breakout, like this one was screamed out from the screen. After taking this setup, the only key is placing a stop where technically correct. What that means is the stop should be where the setup is completely failed. The breakout is turns into a complete reverse, fake in reverse, and technically the trend is no longer where the setup pointed in the beginning. So when this breakout to the downside, as you can see on the right side of the chart, there's a breakout. There's a price and 5 minute chart give you a double top and broke the previous this box, this rectangle, broke the box, broke the side range, close here, and then a confirmation, solid downside to reach at least this low. Okay, at least this low right here. And there was a small trade, but there was a very solid setup. It's very possible it completely could reverse against me, but the higher this is 80% probability, 90% is to go down. Well, it's very high probability to go down. It doesn't matter what percentage, but this is set up to take. Now, where should the stop loss be? And if we don't put the stop loss, if it's a stop loss too close anywhere, like a 1 minute, and based on 1 minute blackjack, it's not gonna work. The stop loss, according to this breakout, should be either above this confirmation, this solid big last white candle, or above this. White is bearish. And then let's go to 1 minute chart, and then how this trade played out. As you can see, there was this real solid downward move, substantially downward move. And the idea is always, no matter in what time frame, is to go and look for it to go back up a little bit. Obviously, we're looking for a pullback and continuation, retracement. So it did do that. It did show that it did show a blackjack. It did printed a blackjack at 21. Now, if the stop is right above the 21, right above the this blackjack, this swing, it can work, and you could get out at stop loss and look for the next setup, whether, well, most likely for the downside again, because price can go to 21, show to go down just a little bit like this, and then as it happens so often, it can go to another level of resistance, another level of sell zone, possible sell zone, which is like 34. It didn't stop there. It went all the way up to 50 minute 50, and it can varies anytime. Anytime it can be different. Every time it can be different. Every time is different. Every time it can turn around and go down from 34 or 50 or even 200. That's where the price action, previous high lows come into very important. The previous pins, like this is a previous pin and this is a previous. This is a rejection of buyer and seller taking control when these pins happen. So originally this top should be right above, right at these pins, right above these pins, behind these pins. Originally, that's the key. If if you have this is the ultimate make or break. If one has a heavy position, and this is for even the best of the best professional trader like David Pagla, say if his forecast, he lost a lot of money first 5 years because his forecast was right, but the stop loss was in the wrong place. And when the position is heavy, not less than 1% risk, then we always going to be very scared. Scared money never wins. Scared money doesn't win. Scared of putting a technical stop and getting stopped out technically. We cannot be having go with that mindset. We have to change the way we think, and that's the only way life will change. Bottom line, wait for a real good opportunity setup of a breakout of a box, complete, confirm, know the target is could be definitely 30-minute 200, and it reached there and might go even lower. Go to look for a major pin ranger like this. This is not a problem, but the stop has to be technically correct. When the stop is not technically correct, that means stop is where the trend has is reversed completely, setup failed, breakout failed completely, breakout turned into fake in reverse. That's where the stop should be, at that point where it shows, where it prints the fake in reverse. Not just it just pulled back, deep little retracement, then another ABC retracement, could be ABCD retracement. This was a great shot. We took that at this outside ranger at 50, in the direction of the MA, direction where the 50 is going, curving towards, and it worked, and I mean right here, yeah, and it's still, and the trade is still slowly moving downward, but now it's a point of where profit taking point, and we did that. That's it. So technically placed stop is the key to survive and thrive and be having making money, making money financially, to financial freedom. Technical stop, and where it's supposed to be, and position sizing, and selecting the number of units that you're not scared to lose, or even if you should just be according to your income and saving. You pick a right position size. Small account, dollar a point, $2 a point. Less than 5,000, $2, $1, $2 a point. Then you go above, accordingly above, and that's it. All right, trade's still going, but the idea is never always place the stop. Expect deep retracement. Accept very deep retracements, like 70% sometime of the whole move, of the pullback. Okay, still go. Anyway, we had the setup, we had the opportunity. This pin ranger showed it's a lot of strength gonna happen in the downside selling, and now it's doing this, and we'll not be playing with scared money, and that's the only key. All right then.